Hi everyone, I'm going to list the top 4 Canadian ETFs to buy going into 2025. Investors that are looking for a passive approach to investing or buying stocks, this video was made for you. This is geared more for beginner investors, someone looking for a set it and forget it style of investing. If you're new to investing, I think it's better to invest yourself than to pay someone a 2% annual fee because this portfolio can mimic or beat what they're providing. Investing in the right ETFs can limit your risk when there's market volatility. I've made a few intro videos about ETFs if you need a refresher. I'll break down my personal choice for the top 4 Canadian ETFs going into 2025. You can buy one of these, all of these, or any combination based on the info I've given you. These annual videos are my most successful, so I make one every year around the same time. Apologies if you've seen it 5 years in a row. All of these stocks I'm recommending you should buy in your FHSA, TFSA, or RRSP. Always use your tax sheltered accounts first. I'll link the intro videos about those accounts as well if you're interested. The last 2 years, the market has had the greatest bull run I think I've ever seen. I can't remember the last time where we had 2 consecutive years with over 20% annual returns. But 2 years of data is such a short time frame. I'm making this portfolio and my recommendations for someone looking to hold for at least 5 years, but ideally 10 or 15. If you need the cash within 2 or 3 years, I don't think the stock market is the best place, just given the volatility and the chance to lose money. Before I get started, if you're a beginner or new to Canadian finance, I've created a course for you called Canadian Finance Pro. It's 8 hours long, over 60 videos where I discuss budgeting, credit, inflation, managing debt, tax, where to invest, and how to invest for beginners. I've introduced a new bonus. With every purchase, I'll do a one-on-one chat for an hour with every new member. Because of this time commitment, I'm limiting it to 10 customers per month. Only 10 people can purchase per month. I'll also be adding an advanced budgeting section as well. So as a member, you'll get access to everything new being added. VFV is the first ETF I'm recommending. This is mandatory for every portfolio. I would recommend 50% of my entire portfolio to this one ETF, and I'll explain why in a bit. If you want to purchase, you'll type in VFV, and I'll try to show it in Wealthsimple and Questrade if you're interested. You can choose VFV or VFV.to. Those are the same thing. The latter is just denoting the Toronto Stock Exchange, and it's in Canadian dollars. If you have US dollars, I would use VOO or VOO, but I won't assume everyone has access to USD. The price is around 146 per share. The dividend is 1% per year. However, you're buying this for the capital appreciation, not the dividend. That's just a little bonus you get every quarter. The management expense ratio is 0.09%, meaning for every $10,000 invested, you'll pay about $9 in fees. But this is not coming directly out of your pocket. You don't actually pay this. It comes out of the return of the ETF, if that makes sense. This ETF mimics the S&P 500, which is the largest 500 companies in the US. But keep in mind, those companies like Apple, Google, Amazon, Tesla, Nvidia, Meta, those are global companies. So you're not actually solely invested in the US. I mentioned earlier this is mandatory because the S&P 500 is considered the market. When you hear people talking about the market is going up or going down, they generally mean the largest 500 companies in the US. They mean this ETF, the S&P. If you want to judge your returns or someone's portfolio returns, if they don't get you the same returns as the S&P 500, there's no point. You're missing out. You're losing money, the opportunity cost. If you're nervous about investing or putting 50% of your portfolio into one stock, if it's 1,000, 100,000, or 1,000,000, just take a look at the last 16 years of returns. Every 10 years or so, we get a correction. In 2008, we had a huge drop during the financial crisis. There's a dip in 2018 and then again in 2022. But if you look at the trend, we're technically 5 years away from another big drop. But just remember, the market always recovers. We can even take a look at the return of this specific ETF, VFV, if you invested 3 years ago, 5 years ago, or 10 years ago, or even since 2012 when it was first created. But if you want a more visual chart, if you invested $10,000 5 years ago and didn't put anything else into it, you would have $21,000 now. VEQT is the second ETF I'm recommending. I would allocate 25% of my portfolio into this one ETF. I'll show how to buy it in Wealthsimple and Questrade. You can use VEQT or VEQT.to. Those are the same thing. If you have USD, I would use VTI. That's the USD version of the same thing. Currently trading at $45 per share. They pay dividends annually, but again, this one isn't for dividends. This is for capital growth, and they get the rare annual dividend. Usually it's quarterly or monthly, so an annual dividend is rare. This ETF is the definition of diversified. You're indirectly investing in 13,469 different stocks all over the world. If you look up what's inside the ETF, it's actually just holding 4 other ETFs, which might be confusing at first, but instead of you, the investor, finding 4 different ETFs to get global exposure, you can do it all with just one purchase, which is VEQT. The management expense ratio is 0.24%, meaning for every $10,000 invested, you'll pay about $24 in fees, but this is not coming out of your pocket. You don't actually pay this. If the market goes up $10,000, you'd make $9,976. I think that's how the math works. If you're wondering why I'm recommending this when I said the S&P 500 is the best return in the definition of the market, well, I'm just trying to future-proof your investment and my investment because I have this as well. In the past, the S&P was the best. The US has been the best investment over the last 100 years. However, that doesn't mean the S&P 500 will always be the best. It doesn't mean the US will always outperform. I want everyone to have global exposure. If the world stocks go up or go down, I want to take the ride up or down with it. That's why I'm investing in VEQT, because of the global exposure. And if you think about it, this ETF also takes into account the first one I'm investing. You're already investing in the S&P 500, so you're investing in the same thing twice. You're buying Apple and Google and Amazon twice, which is fine. I know that I've done this on purpose. Just trust the process. Let's take a look at the returns. This specific ETF was only created 5 years ago, so we don't have 10 or 20 years of data. But if you invested 5 years ago, you'd be up 74%. If you invested $10,000 5 years ago and didn't put anything else into it, you'd have $17,400, which is great. Now, people usually disagree with my third purchase on all these videos. I need to give people some short-term satisfaction, some cash payout. I'm going to recommend XEI. I'm going to add some dividend power to this beginner portfolio. Dividends were my first love when I first started investing. I always wanted that cash payout to feel like I was actually making money. The idea of unrealized gains just wasn't satisfying. I wanted some money, so that's why I went with dividends. But I would allocate 15 or 20% of my portfolio to this one ETF. This depends on how much you decide to allocate to the last one I'm recommending after this. Since my channel is aimed for Canadians, and I'm obviously a little biased, having extensively researched most of the companies on this fund, this ETF invests in the highest yielding Canadian companies. Keep in mind, most of the largest companies in Canada pay a dividend, but with this ETF, you get paid monthly instead of quarterly, which is a nice little boost. The yield is 4.93% annually, so investing $10,000 gets you $493 per year or $41 per month. The management fee is 0.22%, meaning you'll pay $22 for every $10,000 invested. And here's a summary of the industries you'll be invested in. 30% financials, meaning big banks like TD, RBC, BMO, CIBC. 54% is in energy and utilities like Enbridge and Fortis. And then 8.5% in communications like Bell, TELUS, and Rogers. All of these companies have been reviewed and recommended previously on this channel, and I might even do a follow-up on the best stocks to buy instead of just ETF if there's enough interest for it. I'm confident in all the companies being listed here, mainly because they have an oligopoly in Canada. I'm not sure if that's the best thing to say, but there's such a high barrier to entry, and these are all kind of backed or funded by the Canadian government. They're too big to fail. There won't be any new competitors. I don't see RBC, TD, or Enbridge or Fortis ever being out of the top 10 or top 15 of the most valuable Canadian stocks. And now we come to my last pick. I just need everyone to not fight me on this. I need you to accept that crypto, and more specifically Bitcoin, is here to stay. I need everyone to invest 5 or 10% of their entire portfolio into Bitcoin. But hear me out. It's been like 15 years. It's getting more popular. People are coming around, and even in the US, it's part of society now. It's obviously not ready to be a currency yet, but I'm using it to speculate, and it's been amazing. Just take a look at the last year of growth, over 150% increase. If you don't want to hold the coin or you don't understand it, you could use BTCC, which is an ETF that holds the coin for you. Buy this in your TFSA and just hold for the long term. I'll stop there. That makes 100%. But if you're closer to retirement, or if you want something a little safer, just some people want safer in general. Safer means fixed income, aka bonds or interest payments. I'm not a fan of bonds or interest payments or fixed income. I don't have any of it. I'll probably never invest in it even when I'm retired. I'm not interested in low returns. If you want safe fixed income, you could go with VGROW, which is 20% bonds and 80% stocks. If you want even safer than that, you can go with VBAL, which is 40% bonds. And if you take a look at the returns of VGROW or VBAL, historically, they don't provide the same returns as VEQT or VFV. They're safer and less stressful, but also safer means less income. Thanks for watching. Please subscribe to the channel and give a like to the video. Leave a comment if you want. It does help the algorithm. I'm probably going to make this video every year. It's been my best performing. Right now I'm at 32,000 subscribers. Hopefully I can hit 40 or 50K by next year. It's been slow, but I'm not stopping. Thanks for watching and tune into the next one.